Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, I want to talk about equity lenders, alternative lenders, B-banks. Maybe you've heard of them. What do they do, and what type of products do they offer? Stay tuned, we're going to dive right in. Once again, I want to take this opportunity to thank all our continued supporters and viewers, everyone leaving comments, sending us messages, DMing us about questions and future topics and how we've helped people obtain some financing. So we really appreciate it as we continue the financial literacy journey to help educate Canadians about what solutions they have when it comes to mortgages and real estate and everything in between. So on this episode, what I want to talk about is equity lenders. So who are they? Maybe you've heard of them, maybe you're working with them currently if you have a mortgage. So some of the equity lenders that we work with or that you may have heard of are lenders like Home Trust, Equitable Bank, Community Trust, Eclipse, Excalibur. There's probably a lot more, including some credit unions that work in what's this alternative space. Now, generally, these lenders, they also have A side and B side. So it's important to make a distinction quickly between your A's and your B's. Both banks work with income. It all depends on how they approach the income and how they approach credit and the properties. So there are, your conventional A's, your B's, and there's C. So most times C are what we refer to as private, and those are different scenarios which have different products and different requirements. So but we're talking about equity lenders. So how are they different from conventional banks? Equity lenders will look at lower credit scores, blemish credit. So if you're working with your conventional bank and maybe your credit's not strong enough or something happened over the last 2 years, or maybe something happened like a credit proposal or something where a consumer proposal bankruptcy happened, maybe your credit scores, you missed a couple payments because you were off work, these lenders will work with blemished credit and lower credit scores. They also look at different income. If you're self-employed, maybe you're commissioned, maybe your Revenue Canada, your filings are not as high as they were in the past. Maybe you're showing a little bit less income this year, but you need to qualify, maybe refinance and restructure, and your conventional bank won't allow you to do it. There is a space with the equity side. They also look at elevated ratios. So when it comes to debt servicing ratios, where we need to fit a specific criteria with most of your conventional banks and monobanks, which are broker-friendly banks, the equity space will actually allow us to elevate some of those ratios to fit the deal in accordingly. They also will use different rental offsets if you have investment properties and you're having a struggle with the ratios that we talked about and you're looking to get some financing solutions or pull some equity out or maybe go buy another property. These equity lenders will allow us to use a different offset from your conventional banking models. And they also offer equity-based options. So some of these banks have what we refer to as, non-conforming products, but they will look at things in a different perspective than your conventional banks. Now, what products and terms, what is it about them that makes them different? And basically, they also offer many flexible products. They offer open, they offer 6 months, they may offer 1 to 5 years, but generally the sweet spot with equity lenders is 1 to 2 or 3 years. Now, one other concern with equity lending, or one of their criteria, is for the majority of equity lenders, you are required to have at least a 20% down for down payment or 20% of equity in the property. There are specific scenarios where they may ask for more equity or allow us to refinance, but leaving a little bit more equity inside the property. So it all depends on the geographical location or the covenant or the strength of the deal. These equity lenders offer a stated income product. So basically, if you're self-employed, and let's say your income tax filings are not as strong as the previous years, maybe you showed a reduced income, higher expenses, these lenders will allow us to look at raw data, raw bank statements, and try to deduce an actual amount based on that information. They work with New to Canada. Obviously, they work with rental programs. As I mentioned earlier, they allow for higher offsets, so you can squeeze a little bit more, maybe get an additional rental property if that's your goal. They work with corporations and holding companies, basically isolating them from your particular name, even though you're guaranteeing them with them. They do work with different parameters, so please reach out to your mortgage broker for more information about that. And also when it comes to lines of credits and equity lines, they offer these types of lines of credits in behind. Some of these lenders will offer a line of credit in behind other banks. Obviously, there's some additional cost to it, but these products actually help a lot of our clients because maybe they're not able to get a credit card due to their credit score. They have equity in their home and they want to start to reestablish their credit. Sometimes we'll set up a line of credit because it is a Visa and reports to the credit bureau, help strengthen the client's credit over time. And they also work with clients that have gone through maybe some credit issues like bankruptcies and consumer proposal, as I've talked about. Obviously, there are certain limitations with certain lenders, so talking to your mortgage broker to see if that is one of your scenarios, that's in a situation that you've encountered, how to basically overcome it, and giving you the financial solutions to push forward, restructure, clean yourself up, and start over again. And there's many, many other products that they offer that are not available to your conventional model banking, like your top six and your monolines. What are the costs associated with working with an equity lender? So generally, as opposed to your conventional banking model, where there's no fees associated to set up the files and work with them, on the B space or the equity alternative space, generally they charge a 1% commitment fee to the client. That is something that is generally non-negotiable. Some banks may have some abbreviations with fees for higher rates, but generally that is the rule of thumb. On top of the 1% fee that they're charging, that the lender's charging, there are slightly higher rates depending on how long the term or what type of product you're taking. Always depends on the credit and the strength of the deal. As opposed to conventional banking models, the equity lenders are pricing according to risk. That is what is another distinguishing factor that separates your A from your B and your C, is that obviously ratios, credit, all these things paint the picture of your profile. And it may not be the case for you. You might have gone through some hardships, but you do need to understand that these are short-term solutions and they will help you get through to the other side where you can restructure and refinance. And obviously all these mortgages with equity lenders, they're renewable. So in the sense that you sign it for 1 year and maybe nothing changes the following year, something happens, these lenders will allow you to renew with them for a nominal fee. And if you talk to your mortgage broker at renewal time, they can help negotiate that rate for you, as well as potentially reduce or remove that fee depending on the deal. And so what type of deals, what type of clients, I guess basically when we're talking about equity lenders, we've talked about the products and the terms. It's very hard to understand if maybe you as a consumer fit this product or something that can benefit you. But generally speaking, with these types of lenders, obviously, as I mentioned, they're short-term solutions. Maybe a problem happened, you ran into some credit issues, you ran into some maybe income, maybe an employment, maybe one person's on mat leave, maybe one person lost their job for some time and they're not back to work. There could be multiple scenarios in which an equity lender can come to the table and help you get financing, get you the property you want, or maybe restructure. One of the cases that we had with the equity lenders, obviously a lot of our clients who are self-employed, maybe they run a business. In this particular case, they had a business where the income wasn't as strong that they were showing to the government because they had higher expenses. They were looking to buy a home. They were pre-approved for the pre-construction back when they purchased it a few years ago. And obviously that had changed and now their bank declined them, basically saying, hey, we can't help you because A, your credit went down and your income is not as strong. So we positioned it with one of our equity lenders and they were willing to take on the deal as long as the client had the 20%, which they did. And we were able to get them a very good rate for that product, as well as helping them position the next steps. So as a mortgage broker, it's not just about putting the client in with the product and then setting it and forgetting it. Basically, we work with that client to help them restructure, rebuild, help them with their accounting, to help them show more money in their income when the time came to file their taxes. And then basically we're set to renew them next year with a conventional bank on the A side. So that's just one example of how a broker as well as the lenders are there to help our clients get the solutions and the financing they need. What I want to say is it's Finance Fridays. We thank you again to all our viewers and thank you for tuning in. Happy Friday, and we're wishing you a great weekend ahead. Thanks for tuning in.